All right, next deputation will be Gary. Commissioner of Corporate Services, our CFO, to introduce Jim Pruzezes, President of BMA Management Consultant, with respect to our financial health of our city, and we've already been informed that this one may be a little longer than the 10 minutes. Thank you, welcome. Oh, you're going to, okay.
Okay,
Gary,
Madam Mayor, I'll start and then
Thank
hand you over. So,
perfect.
Madam Mayor, members of Budget Committee, this afternoon you've heard about the economic conditions at the macro level and also now at the local level. And before we hear from Jeff about the proposed budget for 2019, we first wanted to understand the financial health of this city, the community that we all serve. In 2014, we looked at the overall financial condition of the city, and it was the first time we had really stepped back and asked an independent assessor to look at multiple financial indicators of health. Now, during that exercise, we completely revamped, and as I said at the time, we cleaned up both the basement and the attic in terms of our financial health. Now, if you've ever cleaned out your basement or your garage or attic before, you understand that it's not long before it starts to get cluttered again. So to prevent that from happening, our finance team has been constantly monitoring our balance sheet, and today I can tell you that we have a rigorous review of our balance sheet quarterly. We are one of the few municipalities who have this sort of support, and it allows us to respond to initiatives such as sudden provincial and federal grant programs, unplanned emergencies, and that there are no surprises for you at the year end. And most importantly, I believe it positions Council to make truly informed financial choices. So my thanks to the financial team and our colleagues throughout the city for their diligence in helping us achieve that. Entering this next fiscal year, Mississauga has received GFOA awards for financial reporting 20 years in a row. This is the longest run for any municipality in Ontario, and for budgeting for 29 years. That's the longest run for any municipality in Canada. And of course, we look for new ways to improve. This year, we were the first-time recipient for our new popular report. And of course, as Janice mentioned, we've now held a AAA stable credit rating for 15 years. So with that said, I'm pleased to introduce Jim Pruzezes. Jim is the President of BMA Consultants, who are the recognised expert in this field in the GTA. We often refer to their work in our reports as we benchmark with our peer group. Jim will present his independent assessment of the financial health of the city. Welcome, Jim.
Thank you very much, Your Worship, members of Council. Thanks, Gary. As Gary mentioned, we've done this review in 2014, and this is an update, if you like. And it's evident from the review that we have undertaken that Mississauga does have a very strong commitment to financial sustainability. Some of the benefits of undertaking a review on a periodic basis, this assessment, it could provide, because what we do is we look at trends on various indicators, socioeconomic indicators and financial indicators, and a financial condition assessment, standing back and looking at it, that can provide an early warning of potential fiscal problems. And as a result of understanding those trends and understanding the socioeconomic and financial conditions, it helps establish long-range financial plans, strategic plans for the municipality, business plans, and financial policies. As Gary mentioned, as a result of our last study, there were some things that, in terms of financial policies, that Mississauga, we recommended should review, and as a result, they have reviewed it, and I think you're in a stronger financial position as a result of that. So our financial condition, there's three areas of focus. We look at growth and socioeconomic indicators. That's looking at things like population, employment statistics. We look at the municipal levy, the spending in the municipality, the property taxes and affordability indicators. And then finally, we look at some of the financial position indicators, reserves, debt, municipal financial position. And the indicators that we're using are pretty much the same indicators as used by credit rating agencies in assessing the credit worthiness of a municipality. So, as I say, this first area of focus is growth and socioeconomic indicators. And again, looking at these indicators, things like population statistics, age demographics, dwelling information, average household income. By understanding the trends in these socioeconomic indicators, it provides a good early warning of the future financial condition of the municipality. And it's the primary determinant of the capacity to raise revenue necessary to provide services. One of the things that we did in the study is we compared the results of Mississauga with some what we call peer municipalities. And we identified other municipalities in the province of Ontario with high population base. And you can see from this chart here, these are the municipalities. When I go through the presentation, these are the municipalities in our peer group that we've compared against. And I'll also show in some of the charts the GTA average. So in terms of population, Mississauga has had tremendous population growth, positive population growth from 2001. It's projected that by 2041, your population will be about $878,000, or 878,000 people. So as a result of that, and as a result of the past growth, that required a lot of new infrastructure in the past that now needs to be replaced. And on a go-forward basis, new infrastructure has to be put in place to service the new residents. And a lot of that infrastructure, that new growth infrastructure, isn't eligible under the development charges. There's a 10% statutory deduction on certain services, certain infrastructure that's put in place. And then some of that infrastructure would service existing development, so it's not eligible. So one of the challenges is that at the same time that you have to replace the aging infrastructure, you're putting in new infrastructure to service growth. One of the other things is in terms of your population growth, it's projected that the future growth will be through intensification and redevelopment. So when we look at the next chart, this is your population density, and again, comparing to some of the peer municipalities. You can see from this chart, Mississauga's population density, the number of people per square kilometer, is the second highest, only to Toronto. And as I mentioned previously, in terms of future population growth, it will be the result of future intensification. So some of that will affect some of your services and service levels. Things like recreation, transit, fire, and roads potentially have an impact as a result of the increased intensification. Age demographics, another indicator to monitor what's happening in terms of the age demographics. And you can see from this chart, which compares 2011 to 2016 on the left-hand side for Mississauga, the population group in terms of 0 to 19, that has been, in terms of the proportion of total population, has been decreasing through those years. And you can see at the bottom, the senior population, 65 and over, has increased dramatically. It's about 25% increase over that 5-year period. And on a go-forward basis, it's projected by 2031, approximately 300,000 will be 65 and over. So again, having that aging demographic, that could affect services and service levels as well. Things like parks and recreation, transit, community planning, et cetera. Unemployment, just listening to the previous presentations, it looks strong on a go-forward basis. We did look at the unemployment rates in the Toronto CMA, and you can see from 2013 it has reduced from 8% unemployment to 6.1%. And as listening to the previous speakers, it's projected to have strong employment on a go-forward basis. Building construction activity, it's another trend that we monitor. And looking at the building construction activity from 2010 up to current, which was August 2018, you can see that it's an upward trend in terms of total building activity. One of the other things that we look at in terms of when we're analyzing building activity is because residential development, it's more costly from a municipal perspective to service than commercial and industrial. What you want is a balance in terms of construction activity. And you can see on the right-hand side of the chart, your residential and non-residential construction activity is fairly balanced through the years. Over the past 5 years, the residential, non-residential construction activity is about a 43-57% split. And that's healthy on a go-forward basis. You want that ICI construction to help support the residential. The other thing that the next thing we look at is the assessment of a municipality. And we look at it from three perspectives. First of all, in terms of the assessment composition, as I just mentioned, you want that balance between ICI and residential. And you have an excellent, in terms of your existing assessment, you have an excellent mix of residential and non-residential assessment. The other thing we look at is how is that changing? And you have a growing assessment base, although it's at a slower pace than some of the other GTA municipalities, but nevertheless, it is growing. And then the final thing that we want to determine is what we call the richness of the assessment base. And what we mean by that is we look at the total assessment of the municipality and divide it by the population to get an assessment per capita. And then that shows the relative assessment amongst all of the peer municipalities. And your assessment per capita in Mississauga is above the peer average. So that reflects a strong base on which to raise taxes. Another indicator, socioeconomic indicator, is gross household income. These figures were supplied to us from Manifold Data Mining. This is a projected 2018 gross income. And you can see Mississauga is about at the group average of the peer municipalities. And in terms of the GTA average of gross household income, it's slightly below the GTA average. So the next area of focus is the levy, property taxes, and some of the affordability indicators. Just to kind of set the stage, your total taxes, the city, in terms of the residential tax bill, in 2018, the city's portion was only 34% of the total bill. And then in terms of the commercial and industrial, because education is a large component of the taxes in the commercial industrial sector, you're only about 20% of the total bill. So what we look at is what we call levy per capita, and that's taking the total net spending of the municipality divided by the population of each of the municipalities to get a net spending on a per capita basis. And you can see from this chart that your net spending is below the peer average and below the GTA average. So that's an indicator that you've got a strong position in terms of holding the line on expenditures. And also identified in the city's business plan, the city has, in the past, the city has identified a lot of efficiencies which results in this lower net spending on a per capita basis. And also on a go-forward basis, you will continue to use lean principles to identify further cost savings. So we looked at taxes, two-story house in each of the municipalities, peer municipalities. We worked with MPAC to get a sample of properties, and what we tried to do is get, as much as possible, like properties in each of the municipalities. So we took the sample of properties, worked out an average assessment, multiplied it by the tax rates in each of those municipalities. And the results of that you can see from this chart here, that the two-story house in Mississauga is below the median and average of the peer municipalities that we surveyed. Affordability analysis. What we did here is to come up with the property taxes on an average dwelling value, we took the total residential assessment in each of the municipalities and divided it by the number of residential properties to come up with the average assessment per residential property. And then we multiplied it by the tax rates in each of the municipalities and then compared that to the total taxes to the average household income. And you can see from this chart on that analysis, you're about 4%. And that's at the peer average. And so you're really about at the median in terms of on the affordability analysis. So financial position is the last area that we looked at. And in terms of reserves and reserve funds, one of the things that we look at is how you manage your fiscal responsibilities with using reserves and reserve funds. And so it's important to have the reserve and reserve funds for stabilization, cash flow purposes. They're a good source of financing for one-time expenditures rather than having a volatile tax rate. And one of the most important things is adequate reserves for the replacement or acquisition of capital assets. So the indicator we look at here is we looked at your tax reserves as a percentage of taxation, and we looked at the trend from 2013 to 2017 and compared it to the group average and the GTA average. And you can see Mississauga, the green line, you're pretty consistent, pretty flat throughout that period. In terms of the GTA average, in 2017, you're at the GTA average. And in terms of the group average, you're above the group average. One of the things, as I said earlier, that as a result of the last study, Mississauga did a review of the policies to identify some of the, or to offset some of the challenges that we identified. And one of the things that, as a result of the policy changes, is you establish, and this is a leading practice, you establish targets for each of your reserves. And what we did is we analyzed the reserve against those targets that you have established. And you can see from this chart, you're pretty much in line with the target for most of the reserves. And most of the reserves are, in fact, trending upward. The two areas, the general contingency reserve, your target is $51.5 million, and you're at about $41.5 million. So you're slightly below the target, but you are trending upward. And then the other one is the building permit stabilization. Again, you're below the target, but you're trending upward. But in fact, the building stabilization, when you go back, I think it was to 2013, you're only at, your reserve balance was only at 49,000, so you built it up to about 6.3 million. The Capita reserves, as I say, it's necessary to have Capita reserves for the timely replacement of your capital infrastructure. So your target valuation, your 2017 target was 98.5 million. You're above that target, and you have been trending upward. However, as pointed out earlier, while the Capita reserve has increased, there is still an infrastructure gap, and you have also an infrastructure gap on an annual basis. In 2018, the infrastructure gap was identified at $260 million. That has been narrowed. The infrastructure gap is $5 million less than in 2018, less than 2017. And so you do have that infrastructure gap, but there are policies in place. You have that 2% levy that was talked of earlier, and that's really important to maintain to come out to eventually close that infrastructure gap. Debt indicators, there's a provincial mandatory indicator that you can't have maximum of 25% of own source revenue, and you have a self-imposed limitation on debt of 15% of own source revenue. And when you look at the actual numbers, you're substantially below your self-imposed limitation and the provincial limitation, of course. You're only at about 3.3% in 2018. Some of the debt indicators, when comparing to some of the other peer municipalities, you can see from this chart, using those debt indicators, you're well below the average on each one of the indicators. Debt charges as percentage of own source revenue, debt per capita, debt outstanding per capita. And your debt to reserve ratio, this ratio, credit rating agencies like to see a 1-to-1 ratio. In other words, I like to see for every dollar in debt, having a dollar in reserves. Your ratio is much better than that. You're at 0.4. Financial position, this is looking at your total financial assets less the financial liabilities. And what we did is we looked at it on a per capita basis. And you can see the trend line on your financial assets less financial liabilities has been trending up since 2014. In fact, it's increased by about 62% from 2013 to 2017. The financial position per capita in comparison to the other peer municipalities, you can see that you're above the survey average and the group average. You can see a couple of municipalities have, in fact, a negative financial position. Taxes receivable, it's important to have an understanding of that. That's kind of an indicator of the local economic conditions. And you can see from this chart, the taxes receivable is a percentage of taxes levy. Credit rating agencies like to see that between 2 and 5%, and you're well within that range. You're at the lower end of that range. And in comparison to the other municipalities, the peer municipalities, you're below the peer average and the survey average. So in terms of summary, I won't go through these in the essence of time, but in pretty much all of the indicators, you have shown improvement. So you were in a strong position in 2014 in virtually every performance indicator, and the financial condition has improved. And that's the end of the presentation, Your Worship.
Very good job. Any questions from anyone? No, I've got a few comments, but I think in the essence of time, we still have a lot to go, so I'll forego, but thank you. It was very, very informative. Thank you. May I have a mover for the deputant, please? Yes, you have questions?
We have an executive summary in our binders. Can we get the full deck of slides?
Oh, I thought it went side by side.
You may have them,
I
but
do have
I
it.
don't.
Yes, I'm sure we can.
Yes,
Can we get the full
we've
deck?
got the full report. We were happy to send it to you.
Thank you.
Yeah.
Okay, yeah, no problem. I was following page by page, so I thought everyone did. Apologize. Okay, did I move the deputant? Councillor Parrish, would you like to move the deputant? Thank you. All those in favor? Any opposed? Very good.